what are wealth clients, as in the businesses themselves, buying? How are they using private assets right now? What is that market?
Yeah, that market has. I'm not playing the fifth. We've only met today, but I'm not being defensive at all. I think it's really important. That market is a pull factor market, meaning the private wealth management firms have come to us, the managers, to say, we want what you have. It's not a push market. And I can argue that if you feel otherwise, but I think it's important to realize that firms like ours had this massive institutional business where very large asset owners in the world have been invested in private markets for decades. For decades. We have data that goes back to the 70s, right? We have, $15 trillion of data through our books going back 50 plus years. This is not new. What we do is not new. So what is new is this arrival of private wealth platforms pulling from that established landscape of private managers and say, well, we want to be able to access that. We want to be investing like endowments, like pension plans. How do we do that, right? So I think that's point number one. It's a tremendous pull factor. Then, of course, you are called to make decisions, right? Are you everywhere? Are you in all supermarket platforms? Are you curating your offering? But the pull has been very strong for over the last few years, and the market has now converged largely on which structure is optimal for that market. And that is the so-called evergreen structures that we can talk about. Again, that is completely now today market-wide. That is a consensus. The fees are in a range, but the design of a structure is not really up for debate. It's really quite established and set. And so now you have the demand, you have the structure, and then you have the offering. And by and large, I'd say we started 5 years ago. So we're one of the largest and oldest in this segment. In 2019, one of our flagship funds has come off 5-year performance levels. I'd say by and large, the early days of this on the offering side were flagships, like absolutely what is our best all-weather program. Quite comparable if you go back to the design of the takeoff of the mutual fund, right? In the beginning, it was like the bulge bracket, one fund for the world, and then you saw an explosion of offering. And I think we've completed those first 4 years with very few products and very established kind of flagship type of offerings. And what we're seeing today, which is part of your question, is that next phase of you go from flagship to all flavors, from vanilla to all flavors, and the market explodes in terms of offerings, right? There's no question of who's at fault. It's a natural demand supply. The private wealth channels continue to ask for more product, and the issuers are having to face that decision. And that's where we are right now at the moment.
Very interesting. So, talk about pull factor, first of all. I suppose the question it raises in my mind is, what are they asking for? Right. So I can understand wealth managers wanting higher levels of return, but if they're also demanding, hoping for a commensurate level of liquidity that just doesn't come with that return, doesn't come with the nature of investments, then there may be a pull factor, but they're asking for something that you can't deliver.
Yeah, I think that the industry by and large struggle with that question because it is a correct theoretical question. And I can tell you about research groups that the indices and the largest banks and managers in the world put together to try to solve that conceptually and analytically. So what gives? What gives is the fact that you've now gone through 50 years of data, and we all have pretty good data on which strategies within the private markets generate which natural liquidity. What do I mean by that? I mean that if we invest in a certain type of short duration private market investing, yes, it's not liquid on demand yesterday, but I know that it's going to generate, say, 20-25% level of distributions on an annual basis. I can model that. I have 50 years of that data, going through all the cycles that I've gone through. If I combine that with some credit, and we've been seeing the explosion of direct lending in credit, now I have some yield to come with that. If you have a strong support from credit facilities, I can have a backstop line for enhanced liquidity. So you can put together portfolios because the growth of the asset class gives you more choices. It's no longer like a one buyout fund or the former like a venture, super liquid venture capital fund. How are you going to get that liquid? You have a much wider, bigger asset class with many more options, many more choices, many more funds. And the portfolio construction process has gotten better. And you can model that. That is where that liquidity comes from and has come from it. I think it's just important to highlight that although we are on a nascent takeoff phase, we've not started yesterday. People dismiss my comment of 5 years. Oh, Juan, thank you, 5 years. Oh, wait. That was COVID. We survived COVID, the panic of Q1, March 2020. We were up and running for a year. You survived the adjustment impulse, you survive the takeoff of growth and valuations, you survive the crisis, the interest rate hike. So these structures generate a level of liquidity which the institutional side knew and had experience, and now we'll have the data to model better. In addition to that, the structures are designed to limit essentially the potential required liquidity in cases of in events of crisis. But they've been tested, and so that's where that liquidity comes from. The rate of return that is expected is exactly as you said it. I expect a private market's rate of return. There's no compromise on that, right? So that's where we are. That's the promise, and that's the premise on which these investments are taking place. And by the way, I would say, it's not an easy market. Sometimes coverage on these interviews, because you have this growth in allocation, it gives you the false sense that, investing must be easy because, they're raising like, wait. It's not an easy market to invest. You look at look at the headlines. You have lower levels of investment pay. That's challenging. You have lower levels of liquidity for the last couple of years. That's challenging. So I'd say you're witnessing the growth in these structures and this channel at a time when investing is hard. And so someone must be doing something right that we're able to accommodate that.
Yeah, that's, it's so interesting when we polled our own readers or the selectors, it covers a broad church of business types, but something like 49% said, yes, we want to have more access, but liquidity is a problem. When we asked them whether they trade off, whether they would trade off return for greater liquidity, 66% said they would. Which I thought was surprising.
Yeah, I think it's not surprising to us, and I think that reality will result, and this is now me entering into forecasting territory for the market's sake, not a Hamilton Lane forecast as such, but I do think that, I think that's a great data point, credit to your research, and that's not affecting the structures already being offered, which answer to the question that you asked me earlier, which is they are delivering a higher level. But if an industry is told that 66% would rather have more liquidity, what I think will happen over the next 5 years, and in part thanks to technology, is that you may see the industry move from monthly to daily liquidity. There are structures in the US trying to get to daily liquidity. And at some point, the cost of that liquidity is going to have to impact returns to a greater scale. And so careful what you wish for, because you might get it, I would say, to your correspondents, in the sense that if the desire is that the experience shall be as liquid as the liquid markets, then clearly there will have to be a cost for it. And I think you're absolutely right. But that's not the experience of the last 5 years. And that might be new design structures in the US, interval funds and others, that will offer at a cost a certain level of daily liquidity. Yeah.